Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Jim Zelter, the president of Apollo Global Management, out with a new report asking the question, what if the world doesn't work the way you think it does? Zelter and the team going on to write, the era of free money is over. Ultra-low interest rates are history. Inflation is structural, not transitory. It's redefining risk, return, and the cost of capital. Jim joins us now for more. Jim, good morning.
I got to hire you at Apollo as a marketing guy. You're doing a good job.
I'm going to go one step further.
Thank you.
I woke up the other week, came into the office, handwritten note from you, and it said, public markets power the narrative, private markets power the economy. Just start there. What is the question you're posing for clients at the moment? What do you want to get them to think about?
Well, it's a bigger conversation about market structure and the changing backdrops about how investors think about investing from a 60-40 portfolio historically and the tools they have to create better outcomes with less volatility. The reality is alternatives have worked for 40 years for institutions. And if we think thoughtfully about the growing need for retirees around the globe, how do we augment what's worked well in the past, but may not be the compass for the future? On the other side of the coin, it's for companies. 8,000 companies down to 4,000. The role of private capital is changing. Companies like SpaceX and Stripe can stay private for much longer. And so a little bit when I hear about your headlines this morning, I feel like many folks that come on talk a little bit about the world in the rearview mirror versus looking through the windshield. And the real aha moment for us came 3 years ago when we saw what was going on with rates rising dramatically in this cycle. And universally, we all thought that the economy would hit skids and there would be tightening financial conditions. And that really didn't happen. So that was a very practical situation where we really said maybe our textbook that we've using all along is wrong. But changing market structure, how companies finance, how investors invest, it is a new playbook, a new paradigm.
Redefining public and private markets. Our good friend Mark Rowan would often talk about this and say often the distinction was risk, higher risk in private markets. And now the distinction I think you and the team want to make is liquidity.
Yeah, I mean, the whole idea when we grew up in a marketplace, this is my 40th year in the business, where private was risky and volatile, and public was safe and liquid. And there's many examples right now. I come from the world of credit, and I started out as a high yield / junk bond trader back in the 80s. And it might have been a public security, but trust me, it was volatile and it was risky. And now over 30 years is now junk bonds have become high yield in an asset class. There's still a lot of inherent volatility in that. And again, we would say that across the whole risk reward spectrum. I grew up in Rochester, New York, Kodak, Xerox, Bausch & Lomb, 3 great American icon companies. They didn't get the memo on disruption. They were safe investment grade companies, and voila, they're not in existence anymore.
Can we talk about how things have changed over the last 40 years? So you and the team would often talk about you are what you originate, you are what you create. The CapEx needs of companies now seem to have changed. I was reading the transcript from your address at a financial markets conference earlier this week, and you talked about the CapEx needs 20, 30, 40 years ago relative to now, and the change in quality, the change in character of things. How important is that, given where we're at?
Well, just to reset that question, in the last 30 years, the high yield market globally has financed companies that are going through either regulatory change or technology change. Think cable, think shale, think airlines, think telecommunications. And for the most part, that massive CapEx was on non-investment grade companies. As we sit here in 2025 over the next 10 years, massive massive CapEx boom between data, AI, sustainability, energy transition, transmission lines, the transaction we did for RWE this week in Germany. And so I don't think people are still thinking that private credit and private capital is small, illiquid, non-investment grade companies. And the reality is 80 to 90% of the private credit market is really investment grade counterparties, investment grade debt. And again, many companies now are afforded the opportunity to stay private much longer because of the breadth and the breadth of the financing markets.
To build on what John is talking about, does private debt have more of a role than private equity at this point?
Well, the debt markets and the capital markets and the credit markets are, as the Congress learned in 07-09, it's the lifeblood of the economy. When GE could not roll over their commercial paper, it was the aha moment for the Congress to say, wait a second, we need to act here. And so when you think about the scope of private credit and scale, certainly the application with investment grade solutions, it's in the multi-trillions, 10 to 40 trillion, and the PE industry is a 7 to 10 trillion, depending on how you think about the dry powder and the overhang. So I would argue over the next decade, the impact of private credit, investment grade and non-investment grade, will probably have as large an impact, if not larger, than private equity has had in the last decade.
So the peak of private equity is over?
Well, I wouldn't say that. I mean, I think that the private equity industry is going to go through an evolution, and it's going to be a Darwinian evolution. And I think that, the challenges of monetization, the challenges of upfront capital commitments, there will be fewer and fewer firms that are able to go to investors and have that dialogue and have that relationship. We believe we're one of them because of our investment track record. But the reality is I think that many PE firms, that business model is going to change, and how can they adapt?
This is a really important conversation to be having, especially because on surveillance, we keep talking about the divide between public markets and the underlying economy. And it seems like it's growing in an increasingly dramatic fashion. And we keep wondering whether the economy is really struggling right now, at least by virtue of some of these labor market pictures, the same time that you're seeing the oracles of the world do very well. Are you seeing that? Are you seeing the need for money to be a little more free now in order to juice some of that activity?
We're not seeing it yet, but I do think the question you're really asking is, and it is the same question about, with the amount, public markets used to be a great diversifier for portfolios, and it really was the bellwether how the U.S. economy and the global economy was doing. But as more companies have stayed private and more companies are funding privately, you really are questioning that barometer and what it's telling you. Torsten has a good piece out this morning talking about the concentration of the CapEx cycle and how it's concentrated in a handful of companies in data, AI, and technology. And while the CapEx is a massive number and it's driving a North Star to growth, you're asking a provocative question, is it really hiding the underlying economy, which is driven by private companies? 90% of the hiring in America is by private companies, and is that a different story today? It could be. We're seeing, if you look at the public numbers in terms of earnings over the second quarter, it beat consensus by 700 basis points, 11 versus 4. And for the most part, the credit portfolios that we oversee, the multi-thousands of counterparty risks, 3 to 4,000, it actually showed quality upgrades 3 to 1 versus downgrades in terms of performance. So in the breadth of our credit portfolios, we're not seeing a weakness. I will tell you, we definitely see more lingering inflation. And I do believe that while this administration is dead set on getting rates lower, I believe that there is a legacy inflation issues in the economy. When's the last time any one of us bought something in the last year and you said, wow, that was cheaper than a year ago? It has not happened. And that's just and I do believe that's going to be the scourge of this rate cycle, because I do believe there's greater inflation, and companies are having a much more challenging time passing that along to consumers. We're seeing it across the board.
There's a lot to unpack there. One of the things I wanted to unpack was the concentration risk and the AI financing that we've seen both in data centers and the energy transition. There's a quote in the last year that's just stuck with me for the last 12 months, and it came from the Alphabet CEO, that the bigger risk is underinvesting and not over investing. And that just sounded like a commitment to over-investing. Now, I'd want to understand how your industry avoids a massive misallocation of resources at a time when everyone is chasing the same story.
Well, it still feels like you have a bug in our investment committee rooms. I mean, I've been talking the last 6 months about the cycles of dark fiber in the late 90s, of shale, in the early teens, 10 to 12 to 16, and certainly enterprise software the last 5 years. And you have to be concerned as an investor today, are you taking equity risk for a fixed rate of return? That's the ultimate sort of bubble, if you would. And I don't think that the true economics, certainly consumers, industry, the economy is going to benefit, but not all industries as they evolved was it a great investor to be an investor. The cell phone industry is a great example. Only in the last decade has it become a good investment for companies to invest. So I don't have the answer to that one. It's a question we're asking ourselves. Now we find ourselves both on the debt and the equity side of funding a lot of the data center activity, but there's a tremendous amount needed, and there's a voracious appetite. But I certainly understand what the Alphabet executive was saying.
Do you think there's a bit of a duration mismatch between how long it takes to build a data center and how long it takes to build the energy infrastructure to enable it? And could that be problematic in the future?
There certainly is. We have spent more time. The energy supply issue could be a governor to growth. And that's a challenge that we've not seen yet, but if you pencil out the numbers, that could be a concern. But I think the bigger question is back to the first one we asked is, these are 10, 20, 30-year infrastructure builds. Who really, with our marketplace going towards indexes and ETFs and multi-pod shops that are all thinking about, moment-to-moment liquidity, the era of the long investor is a question mark. Who is that long investor? And we would say it's the retirees of tomorrow. Every day, 12,000 folks in the U.S., hit 65, and the West, broadly speaking, and other countries around the world have not done a great job with retirees. And so the ability to thoughtfully introduce long-duration infrastructure, inflation hedge assets into these portfolios. In the UK, they call it matching adjustment for insurance assets. Those are really where the growth of our business is going to go, and that's going to benefit investors.
This makes a lot of sense, particularly if you're investing for retirement. You don't need daily liquidity. That's just logical. I think where the criticism is coming from for your industry at the moment is that family offices are already doing a lot of this. I think you and the team have talked about that a ton. High net worth individuals are doing the same. You're now going after retail. And then people start to feel a little bit uncomfortable with that. Are you looking for a new bag holder? Are we looking for someone else to pick up the pieces? What's the response from you and the team to address that head on?
I think it's all about doing it in a methodical, logical, diverse way. This is all about the proper amounts and the proper diversity. Certainly, we would never advocate for someone taking an outsized portfolio of their retirement and putting it all into alternatives. But clearly, over the last 30 to 40 years, history has shown us that an allocation to alternatives, 10 to 20% of a portfolio, increases returns and brings down volatility. And so from our perspective, there's a variety of areas in the world of credit in particular, the world of infrastructure, the world of secondaries that are more yield-oriented, compounding type of vehicles. And certainly we have a view that private equity, while a very attractive asset class, even in returns over the next decade, mid to high teens, that should be done in appropriate doses. So it's all about diversity and proper portfolio allocation.
Stay with us. More Bloomberg Surveillance coming up after this. Congressman French Hill, chairman of the House Financial Committee on Financial Services, joined us now for more. Congressman Hill, welcome to the program, sir. I've got a lot to get through, and I just wanted to start with the independence of the Federal Reserve and the role that your committee's got to play as this spat continues to build down in Washington.
Well, good morning, Jonathan. Great to be with you. As you know, I've spoken out many times about the importance of the independence of the Fed, and so has my colleague across the Capitol, Tim Scott, the chairman of the Senate Banking Committee. But because we fully support Fed independence doesn't mean the Fed's immune from criticism. And every president in my adult life has been very vocal about criticizing the Fed at one time or another. So I don't think Fed independence is in question.
When it comes to what could actually happen in terms of financial stability, we have Fed Governor Lisa Cook's lawyer saying that the president was unlawful in removing Governor Cook and said its vague allegations would endanger the stability of our financial system and undermine the rule of law. Do you agree with that assessment?
Well, I think there's some hyperbole in there. Lisa Cook has been accused of effectively mortgage fraud. Those are significant allegations for someone who is a financial regulator. But I think they need to be adjudicated. I mean, she needs her due process, her day in court to prove that, in fact, that's not the case. And I think that's underway right now. And that's, again, something I've said in recent days.
Do you think the president should have waited for the courts to play out in terms of this investigation, for these allegations to actually become charges and a conviction, to then take up this idea to fire her for cause?
Look, the president's entitled to his own opinion. He has access to the facts that probably I don't, so he's made his decision about it. But my judgment is that's a serious allegation, and if true, it's certainly potentially a disqualifying allegation and charge for someone who's involved, very much intimately involved in the federal regulatory process.
Taking a step back, though, do you agree with the Treasury Secretary on resetting the Fed's mission?
Well, you know, I've believed that for a long time. I believe the Fed should have a single mandate, which is price stability. The biggest, most punishing tax on the American people, our citizens, is inflation. And inflation's caused by too much money chasing too few goods. And we've had a dramatic example of that by Fed policy during the pandemic and the Biden administration's fiscal policy in combination. Very punishing, 40-year highs in inflation. So I believe we need fewer mandates, and I think we need that monetary policy focused on price stability. Again, that's why I set up a task force in this Congress to review the Fed's monetary policy since 2008, review the Fed's role in financial regulation and supervision, and to make sure that we're also taking steps to make sure our Treasury security market is resilient. All this work is led by Frank Lucas of Oklahoma, and we're deep in that process. So I think taking a strong look at the Fed's monetary policy and their governance, it's an important factor, and I agree with the Treasury Secretary on that.
Well, inflation has not been below 2% for more than 4 years at this point, and we're still talking about 50 basis point rate cuts, maybe 75 basis points of rate cuts this year. Do you think that that's premature if this should be a single mandate Federal Reserve that looks solely on inflation?
Well, I think this is the tough decision they have coming up, and we've seen a softness in the economy during the whole year in terms of consumers' ability to purchase, the jobs reports that we've gotten. This is why the Fed chairman, I think, consistently has said, let's look at the data, look at our data assessment and the forecasts associated with it, and also make our own judgment about whether we're at the neutral rate for pricing, because we don't want to see the economy stall out and then go into stagflation, particularly when you're right about inflation getting close to 2 but not below 2 and not right at 2. But when you look at inflation expectations, they seem to be more closely anchored at 2, and that should give the Fed some confidence as they entertain their decision in the next few days.
Chair Hill, I know you and your colleagues almost just recently got back from summer recess, but October 1st is fast approaching, and the Trump administration is weighing and pushing for this idea for a stopgap funding measure to keep the government open through January 31st. Would you be on board with that?
Well, we're talking about it among ourselves and obviously with our friends in the Senate. We've each passed 3 appropriations bills in the Senate and the House. I think it would be great to go to conference on those bills and then pursue, get those enacted into law, and then pursue a CR that's a shorter term CR would be my advice for consideration, so that we can get this work done. We're very close. Both the House and Senate are processing these bills. We have the Republicans in charge of the House and the Senate and the White House, so we ought to get together, find our top line number, and get our work done this year.
Congressman, before you go, the important stuff, Arkansas football. Razorbacks going to get done this year?
Really enjoyed watching the quarterback come and have his great game against Arkansas State. This was the first time in Arkansas history that Arkansas State played the University of Arkansas in Little Rock at the famous 1949 War Memorial Stadium. It was a fantastic day. He looks pretty good. We play Ole Miss this weekend, so that'll be the first SEC game, and that's where the rubber hits the road.
Stay with us. More Bloomberg surveillance coming up after this. Let's get the bullish view on things. Dan Ives of Wedbush, 270 price target, outperform rating on shares of Apple. Dan joins us now for more. Dan, good morning.
Great to be here.
You've sat here so many times in September alongside us and talked about the upgrade super cycle. It hasn't happened. Is it about to happen with this, and why?
No, I mean, this, and those super cycles we've talked about, I mean, they definitely were disappointing, right? I mean, the reality, I think this is one where street expectations going in are, I think, pretty soft relative to next year. So when you think about on a scale 1-10, this is probably going to be an 8.5. Look, you do have over 300 million that haven't upgraded their iPhone. Is there going to be a huge catalyst here? I think a lot of it's just pent-up demand, especially in China. But the reality is, the elephant in the room, it's AI. And I think that's, when you talk about what's going to truly drive the stock, that's it. And we've talked about it. That right now is front and center.
Before we get there, and we'll find out more, I'm assuming, later this year at the WWDC, there is this signal from the fact that they didn't raise prices on the phone significantly, except for the highest end phone. Does this suggest that they're going to take it more on margin, especially given how much their costs are increasing pretty much across the board?
Yeah, I mean, some small price increase book. I think also the reality, that's why Cook, played nice in the sandbox with Trump, right? Because it's very important in terms of India and China, make sure they do have some exemptions when it comes to the tariffs. But look, the reality is they cannot raise prices significantly at this point, because the last thing you want is churn, other competitive issues. You have a phone that's definitely an improvement, but nothing that's jaw-dropping. And it all leads, the whole reason you own Apple, it's the install base. I mean, it's all about when they monetize the 1.5 billion iPhones for AI.
Can I just jump in? The install base. For a long time, you've seen that as a source of potential growth. Isn't it about time to start seeing it as a source of potential risk? That you've got this massive install base that hasn't upgraded for a long, long time. Don't we have to start questioning whether they ever will? And whether the real risk here is they might actually go and buy a different phone from someone else?
Look, we've talked about that. That's why we've been so, I think, strong in our view. The clock struck midnight in terms of them needing to now. Goes back to AI, because when you talk about monetization and what keeps people in the ecosystem and what really is the golden goose for monetization, it comes down to AI. And the reality is, every Apple event the last few years, I feel like Michael J. Fox Back to the Future, and that's been a big part of the problem relative to the rest of tech when it comes to embracing AI.
The install base is sick of waiting. That is sort of a worry that a lot of people have. And Samsung right now and Google are out there trying to troll everybody who's been waiting for something new and saying, ha, 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 look, ours fold. Yeah. There's a question about, especially if they're getting a heads up or if they're getting a head start on the AI development, of whether the install base starts to leave. Aren't we starting to see signs of that? Doesn't that worry you?
Look, I think it is it's probably the stickiest install base out there, right? In terms of just when you think about Apple and customers that really don't leave. I think the worry is really around the monetization. And that's why we've said, Perplexity was really more to see what happened with Google. Once they had that victory, now I think they walked down the aisle from some sort of major partnership from a Gemini perspective. But I think this is a critical time, next 6 to 9 months for Apple, to make sure you have the AI strategy, you don't lose customers, you have an upgrade cycle that, right now New York City cab drivers bearish on Apple, so I think that sets up pretty positive relative there. But it comes down to AI innovation. There's a better chance of me playing Ryder Cup Bethpage than that happening inside of Apple. It has to come externally.
Dan, you mentioned Tim Cook playing nice in the sandbox with Donald Trump. Should he go on the state visit next week when Trump's bringing a bunch of tech executives like Jensen Huang?
I think you get on that plane because, I mean, you know it so well. It's like he obviously got called out in terms of Middle East. To the right, you have really the new trusted advisor wearing the black leather jacket, Jensen. I mean, Cook needs to make sure he's not on the outside looking in. And that's why that, what we saw last week in D.C. was also an important moment, too.
When you say that he's playing nice in the sandbox, when Lisa was asking about pricing of iPhones, he's constrained, do you think, by the White House and audience of one, or do you think he's constrained by where the consumers are right now and has to meet them where they are?
Yeah, I think it's a combo, but I think the reality, too, is that raising prices definitely is not the right thing to do from a consumer perspective. But when it comes to tariffs, that's also where, they're essentially doing a dance around, right? When it comes to India and China, tariff exemptions, obviously significantly investing in the U.S. But like we've talked about, it's a fairy tale that they'll ever make iPhone Pros in the U.S. Again, it goes back to if you like $3,000 iPhones, we should make them in New Jersey. So I just think that that's going to continue to be something that's in Asia, despite obviously a lot of the investments from an AI perspective in the U.S.
You're a bullish guy. Let's just finish on a really big name this morning, Oracle. $225 billion plus of market cap could be added to this company later on this morning. We're higher by 32% in the pre-market. What do you make of this move?
I mean, it's a drop the mic from Safra and Ellison, right? Because the reality is that it shows this AI revolution, as much of the haters and the skeptic, you look at...
points to me.
No, I'm saying, dude, you're a big supporter. But I'm saying, but Lisa, I think the reality is that many that are skeptical of maybe some of the growth, you look at these numbers, that ARR number, that's a drop the mic. And I think what that shows, the rest of tech, the rest of AI, that's what we continue to say. It's 10:15 and the AI party was 9 p.m. and that party goes to 4 a.m.
It's an outfit worthy of the stock move. It's good to see you. Thanks, Dan.
Great to see you.
Appreciate it, sir. You've got the distance to play Beth Page.
You never know. It's more of a short game. I don't have Farrow's long distance.
I wish I had that kind of distance.
Yeah, exactly.
Like McElroy 350 kind of stuff.
Exactly. Beth Page Black. That tests the distance.
I'm very pro-America. That's going to be like the few days that I'm going to be very pro-Europe on this program.
I know.
Oh.
I'd expect.
You're going to have to let it go.
Of course.
Just give me some space.
But again, the difference is Europe doesn't have a guy named Scotty.
Stay with us. More Bloomberg surveillance coming up after this. Seth Carpenter of Morgan Stanley. Seth, good morning. It's good to see you.
Good to be here. Thank you.
I want to give you some time before we get into this data point to flesh out how you view the world right now, because I've been following your research, and certainly you and the team consider what took place on April 2nd and the months after that, not as an event, but as a process. And we've got to wait to let this play out in the coming months. Just flesh that out for us. How you're thinking about the world with regards to tariffs and the pass-through to end inflation.
Yeah, no, I think that's a key question. And I do get the sense, talking to lots of investors around the world, that people feel like we've seen tariffs. We've seen sort of how high they could go. We've seen a retracement. We get it. Now let's move on and look at what's next. And I'm not sure we can quite move that quickly. Evidence we have from 2018 to 2019, evidence we have now this round, is that it takes 3-4 months before you really start to see the effect of the tariffs show through to consumer prices. The last two CPI prints, in fact, we were able to get evidence that in at least the core consumer goods components where we expect to see it, you are starting to see an initial pickup. It's not crazy. It's not the inflation that we saw a few years ago, but it's moving up for sure. I think the tricky part here is going to be the tariffs were much broader than what we saw in 2018, so trade diversion is going to be harder. On the other hand, there's a lot more negotiation back and forth, so how many industries are going to be gaming, absorb it for now, pass it on later, and I think that uncertainty is critical. I think we still have a lot of additional inflation from tariffs in front of us. And then what we can't forget as well is that tariffs hurt economic growth as well. In 2018, the evidence was 6, 7, 8, 9 months of a lag. We're just coming up on that in the fourth quarter and then into next year. Take the imports from China. 2/3 of what we import from China are either capital goods or intermediate goods that go into manufacturing in the U.S. So the tariffs are a tax on domestic CapEx and a tax on domestic manufacturing. The tax provision helped on the CapEx side of things to some degree. Tariffs are going in the opposite direction. Where's the net? How are things going to work out? I think these are the reasons why no one should feel like they have the whole picture already clear in their head.
Yeah, well, what you just described sounds a lot like stagflation, which no one should feel too happy about. It's always kind of the disaster, at least stagflation light, as some people have been describing it as. Do you disagree with Fed Chair Jay Powell, who said that any kind of inflationary pressure from tariffs will be a one-time price adjustment? And that is the reason why this central bank seems to be placing a greater emphasis on the slowdown that you're talking about, or, as we saw yesterday, some of the revisions in just the labor market lack of momentum that we've seen.
Well, I think as a baseline forecast, and we have to make our baseline forecast, the answer to that is, yeah, the most likely outcome is that tariffs will lead to a one-time increase in the price level, which means that the inflationary effect, the percentage change in prices, will be temporary. I think that's a really great place to start a forecast. That's where our forecast is. That's not, though, the only game that the Fed has to play. They also have to ask, well, what if we're wrong about our forecast? What if things turn out differently than our baseline? And in particular, the last time we saw tariffs, and it was temporary, we had the biggest problem for the Fed was too low inflation, not too high inflation. Here we are over 4 years into inflation being above the Fed's target for a long time. Businesses are kind of getting used to inflation being high. Consumers might be getting used to inflation being high. They might be getting sick of it, but they also might put less effort into thinking, oh my God, do I have to go look somewhere else for an additional lower price? Because now everything's just more expensive. So I think there's a risk that the inflationary impulse is longer this time, gets more embedded. And let's not forget, in the services component of things, we have now labor restriction going on because of immigration. We talked about the revisions to the labor market. Job creation was less than people thought. Job creation has come down a great deal. The unemployment rate, 4.3%. I'm old enough to remember when 4.3% was actually pretty good, and it's about unchanged. It's only up a little bit from a year ago. What that to me says is that the labor supply side of things has also come down a lot, and so then the question becomes, how do the services industry, especially the ones who might find themselves constrained for labor, how does that show through in prices?
So that brings us to the data that we get today, which shows that inflation really isn't as big of a concern as some people expected when it comes to producer prices. We'll see what CPI has to say. Some people are calling for the Fed to cut in a more significant way next week, maybe even 50 basis points. Do you think that if they were to do so, or even 75 basis points, let's cater to that Bloomberg subscriber, do you think that that would actually ignite the risk of inflation over the medium term, or do you think that that would be appropriate?
So I think the risk is that it would be premature to cut 75 basis points for sure, and even 50 basis points. I don't know, from my judgment, that it balances the risk between slow growth and inflation. Now, newsflash, I am not the chair of the Fed, so my opinion is much less important.
Yes, I hear that you could be in the running.
So the way I think about it is they've got a dual mandate. Full employment, maximum sustainable employment, i.e., how close is the unemployment rate to what they perceive to be full employment, which they've told us is 4.2%, and stable prices, which they've defined as 2% inflation. Inflation's above target, inflation's rising. It's not skyrocketing, but it's going up. Tomorrow's CPI is going to be really important for the consumer goods side of things. So where is that balance of risks? I think that's really the question. What Chair Powell told us at Jackson Hole was he changed his mind a bit and said, you know what? Now we're going to lean more on the risk of employment getting weaker and accept a little bit more risk on inflation going higher. At the prior FOMC press conference, though, he kind of had said, let's look at the unemployment rate. You know, you could imagine payrolls coming down a lot. As long as the unemployment rate is stable, that's what full employment, maximum sustainable employment is really about. So there has been a little bit of a change in that risk adjustment. There's no black and white. He's clearly wrong. He's clearly right. This is a very, very difficult situation for the Fed. Their two variables that they have mandates for are kind of going in opposite directions. That is the most difficult situation for a central banker.
Well, he went full Waller basically at Jackson Hole. But to John's point all morning, if they had had this information in terms of actually where the economy was, the labor market was, do you think they should have been cutting? Would they have been cutting sooner?
I mean, I think there's clearly the argument that they might have been cutting sooner given where Powell is now, given his remarks at Jackson Hole. Given his remarks, though, at the July press conference that the unemployment rate, which is saying how is labor demand doing relative to labor supply, it's much less obvious that they're anywhere near as far behind the curve as you would infer just from a read on the non-farm payrolls print. So this is an extraordinarily difficult, nuanced, tricky situation. It is the time where it's both great to be an economist because we get to go into the details, and it's terrible to be an economist because nobody wants to hear it. Well, actually, a lot of details here matter a lot.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.